Hello everyone, I am going to start this chapter on banking system. First we have to know about the issues in banking sector. In our Indian banking sector, non-performing assets are very high. Also, the traditional approach and lack of innovation is there. Hesitancy to give big-ticket loans, unserved needs of specific segments of society, and also inadequate capitalization. Now, what are the advantages of NBFC? NBFC take care of the MSME sector. They also develop the Indian economy. They create financial inclusion. They aid in employment generation. They also help in greater innovation and infrastructure lending. And they also have specific sectoral focus. Now, NBFCs are registered under, wait, to first highlight all this. Okay. NBFCs are registered under the Companies Act 2013 and also they don't need banking license. They can't avail NEFT or RTGS and DICGC facility is not there and passbook issuing and check is not allowed. Also, foreign investment is allowed up to 75%, for, which in banking companies it is allowed only up to 75%. Here it is 100%. And at the same time, they are also regulated by RBI. Okay, so what is shadow bank? Shadow bank, this term was coined by Paul McCulley during the global financial crisis of 2008. This signifies any financial activity outside the banking system. NBFCs thus fall under the shadow banks. Now, according to RBI, definition of NBFC, any company registered under Companies Act which can accept and lend money can be called NBFC, but they must have approval from the central government. Okay. Now, what are the scopes of NBFC? They help in lending and financing of activities, acquisition of shares, acceptance of deposits for a minimum 12 months and maximum 60 months. They help in dealing in other businesses, street funds, etc. What NBFCs can't? They can't do agriculture operation, industrial activity, purchase or sell goods, retailing services, sale or purchase of immovable property. Now, what are the different types of NBFC? Uh, Types of NBFCs are choose some different color. Okay. Types of NBFCs are based on acceptance deposit from public. First is deposit taking NBFC, which are NBFC-D, and then non-deposit taking NBFC, NBFC-ND. Then based on deposit size, all NBFC which are systematically important. Uh, but for all NBFCs are systematically important, like all the deposit taking. But for NBFC-D, like NBFC non-D, non-deposit taking, the asset share should be more than 500 crore to be NBFC-ND SI. Meaning NBFC non-deposit taking systematically important. Now, based on different activities performed, NBFCs are classified on that category in which 50% assets from that category also generate 50% revenue. A financial asset for that asset should be more than 50%, except financial FDs and incomes from those financial assets will be more than 50% also. This is actually the 50% test. Now, rules for NBFC by RBI. It should be registered under Section 3 of Companies Act 2010, 2013. Should have a minimum net owned funds of rupees 200 lakhs. Minimum capital adequacy ratio. AR is 50% of its aggregate risk weighted assets on balance sheet and adjusted value of off balance sheet items, and same for Tier 1 capital ratio at any point should be not less than 10%. And this is also for risk-weighted asset of on balance sheet and risk-adjusted value for off balance sheet items. This is very important. Now, what are these like regulated by RBI? There are two kinds: high-risk finance companies and other NBFCs which are registered with RBI. Now, regulated by SEBI are venture capital fund, merchant banking companies, stock broking companies, mutual funds, collective investment schemes. Regulated by PFRD are the pension funds. Regulated by MCA are the mutual benefit companies and Nidhi companies. Regulated by state companies are the chit funds, and regulated by IRDAI are the insurance companies. These are the different types of NBFCs. Now there are four layers: base layer, middle layer, upper layer, and top layer. For base layer, we see the asset size should be 1,000 crore. I think it is now 2.5 tons, so it should be 2,500 crores. And these are the NBFCs falling in this category. For middle layer, NBFC deposits, irrespective of size, and NBFC ND with asset size of 1,000 crores and above. For upper layer, NBFCs are identified by RBI based on parameters and scoring by methodology. Top 10 eligible NBFCs in terms of their asset size, irrespective of any other factor. For top layer, they should ideally remain empty and substantial increase on potential systematic risk from specific NBFC in upper layer in the opinion of RBI. Wait, substantial increase in the potential systematic risk from potential in the upper layer of our in the upper layer in the I'm not able to understand this. Substantial increase in potential systematic risk from specific NBFC in the upper layer and the okay, whatever. This is not needed. Okay. Now, what are the types of pension schemes needed right now? Okay. Okay, so first is National Pension Scheme. It was introduced in 2004 and it is a defined contribution scheme that invests in equity and debt instruments according to the investor's preference. Next is Public Provident Fund. It is a long-term investment option and it offers attractive rate of interest and return on the amount invested. And interest earned and the returns are not taxable under the income tax. Employee Provident Fund. This gives retirement benefits are accumulated on this scheme. An employee has to pay a certain contribution. Employee has to pay a certain contribution towards the scheme, and an equal contribution is paid by the employer. Now, what is Nidhi? Nidhi actually, this is a system in which all the members pool their money at a like for a specific objective, and they operate for a common benefit as well. And like this helps the members to inculcate a habit of frugality and saving among its members. And it is recognized under the under Section 406 of Companies Act 2013, and it does not require RBI's permission. Members pool their money with a predetermined objective. That is all. Now, what are chit funds are actually managed by states, and it has an act of 1982, and it is a miscellaneous non-banking financial company, MNBCs. Now, risk for non-banking system is systematic risk, shadow banking risk, liquidity mismatch risk, credit quality, and of non-performing assets, risk of investor protection, concentration risk, risk of regulatory arbitrage, and risk from loose regulations. So I think that is all for this chapter. It was a small chapter.